Good day, it's Brian from quantlabs.net. I just put up a new posting on the critical things that you need to know about when it comes to trading, especially in today's environment with low volatility, using statistics and probability with things like normal distribution versus empirical distribution. So the goal is to understand price movement analysis on your asset that you're potentially forecasting with against some form of an index, let's say like the S&P 500. The goal is to reduce our exposure to reduce risk so that we minimize our trading loss. Now, I'm not going to go into great detail here, but this will be part of the back end of my upcoming signaling system or alert system that I'll be putting out, because this is going to help protect my basically my portfolio for any new trading potential opportunities out there. Now, this is the warning that I want you to take away from this video. Now, everyone lives their own life. You do what you like, but if you don't understand this, especially in these last two paragraphs I'm going to highlight here, you will get wiped out very quickly, usually within a day. Just think 2008. And those days are coming, believe me. As the market tops, panic sets in. There's going to be some extreme market movements. So in essence, what we're doing is that we're using statistics and probability to analyze not just what we're about to trade with, the forecast on the risk potential of it, but also to understand the direction of, like I said, an index, S&P 500, let's say. So we can use Excel as a tool, especially with the data analytics added as built in with Excel. And what we're doing is we're trying to calculate our average return with the index. We analyze, calculate our median, mean, standard deviation, all that. You've probably seen enough times. We have our standard deviation that we can calculate from it. We can also calculate our kurtosis and skewness from it. We can learn from that if the higher the kurtosis is, the more peak that normal distribution chart will be. So what will happen typically is you will get fatter tails. And it's the fatter tails you got to be very careful of, because the positive ones on one side can be high profit potential. And the other side is what we got to be aware of in terms of market movement against your position that can wipe you out. So of course we have to calculate probabilities using all these different bins. Again, all this can be done in Excel. Here's a formula that you can use, a little hint, using this data filter add-in. And also, we want to calculate our positive and negative. So these are the two warnings that you should know about. You need to understand the percentage of your up days versus your down days with the S&P, especially your asset against your S&P 500 or what your index will be. What you'll see is that your up potential is a lot lower than you think, and even when you factor that in, you have to count for transaction costs, of course your brokerage fees, as well as low volatility, right? So when you do a calculation of, let's say, an analysis of your, let's say, percentage with a standard deviation of 1 to 3, both on the upper and lower bounds, you can calculate your average and your percentage and calculate your risk, which is, again, really critical. Now, again, this is average returns over a certain period. It could be monthly, daily, as well as weekly. If you use intraday, there's a lot of noise there. So this will most likely not work for intraday. But over long term, if you have a long-term trading horizon. So again, in summary, you will see that there's greater risk in the extremity of the tails of your distribution, and the more probable there could be days where you could get wiped out. So you kind of need to know those calculations. And with the returns, you can see that obviously using typical things like technical analysis to help you calculate that when those days are coming. And wouldn't it be wunderbar if you could do that all in an automated way? Well, I know what you're asking. Well, will I have a spreadsheet or will I have anything in an automated way that can do that? No, I don't think so. I'm just giving you the hints on how you could kind of do it. I do have a spreadsheet out there that does this, but that's going to be part of my backbone for obviously my risk management and be able to calculate anything on particular assets against any index that I choose, because I'm just using average daily returns. And the data can be from Yahoo. Now, I've been talking about this a lot in the last week or so over here at the Academy. And here's some of the other postings in regards to that. Now, I'm not going to go into this too much, but there are lots of other things that I'm building out as part of my system, right? Now, the system has a name called the AK-47. And people ask me, why do I name it the AK-47? Well, one of the most dangerous weapons on the planet is, of course, is determined by guns. Now, if you haven't seen this video of a chimpanzee and an AK-47, this little chimpanzee doesn't know what he's doing, but he could be doing very dangerous things. And that's what the system will do, and it'll expose a lot of that to help you reduce your risk. Now, I'm not going to release this system, but in essence, what will happen is that this will be part of my data analytics service that I'll have for all my members. Okay? So if you're ever interested in learning about these sort of member things that I do talk about, let's come over to the Academy. It's very simple. You will find we have an elite service, and you just click on here, be an elite, profitable elite quant. And we go through the usual blurbs, the benefits, and you just get started by hitting that button. Hopefully, that will keep you in the game over the long run, and I hope you take away some valuable lessons from what I've just talked about. Talk to you later.